10 years, that is the window I care about. Most people are going to spend the next decade doing exactly what they did in the last one. They will trade time for money, buy liabilities they call assets, consume the little margin they do create, and then act surprised when the numbers barely move. They will stay busy. They will stay tired. They will keep mistaking motion for progress. I have watched that pattern for a very long time. It never ends well. Wealth is not built by accident. It is not built by enthusiasm alone. And it is certainly not built by collecting information like a hobby while failing to act on any of it. Wealth is built by owning assets early enough, feeding them long enough, and understanding the difference between what looks rich and what actually compounds. An asset is anything that grows in value or sends returns back to you over time. That includes obvious things like stocks and real estate. It also includes things most accountants will never place on a neat balance sheet, even though those things may matter more than the neat balance sheet in the end. That is the real conversation. So if I were laying out the assets that can make a person rich over the next 10 years, I would not start with the most glamorous one. I would start with the ones people ignore. The 15th asset is your children, as education and the legacy you leave behind in their thinking. Most people skip this because they cannot pull out a phone and check the price of it. There is no ticker symbol for judgment, no chart for discipline, no quoted market for whether your children understand money, delayed gratification, trust, or responsibility. But I have watched families create fortunes and then lose them within 2 generations because they transferred money and failed to transfer wisdom. That is not a market problem. That is a human problem. If you raise children who understand systems, effort, patience, incentives, and how money actually works, then you are building an asset that may outlast every portfolio you ever construct. If you fail there, the money can disappear faster than you imagine. So when people ask me what the longest duration investment is, I often think it is not a stock or a bond. It is whether the next generation knows how to carry what you built. The 14th asset is your ability to use artificial intelligence and automation. AI itself is not a magic money printer. The skill is not owning the machine. The skill is directing it. The person who learns how to compress 8 hours of effort into 45 minutes and then keeps using the freed time intelligently gains something extraordinary. Not because a chatbot is clever, but because leverage changed. We are in one of the great productivity transitions of modern life. The person who knows how to use AI to research faster, write faster, code faster, sell faster, analyze faster, market faster, and build faster will not merely keep up. He will outrun people who still think effort has to be manually repeated in the old way. That matters because every other asset on this list gets easier to build when your output rises. The 13th asset is buying small businesses that already work. Most people imagine business wealth as a startup story, a garage, a struggle, years of uncertainty. Sometimes that is how it happens. But there is another path the wealthy use all the time. They buy businesses that already produce cash flow, cleaning companies, niche software service firms, boring local operations, businesses owned by people who are tired, aging, or ready to retire. That is one of the quietest opportunities of the next decade, because millions of owners will age out of their businesses and need a buyer. A small business throwing off $200,000 in annual profit can sometimes be bought at a multiple that makes far more sense than the market gives you in public equities. Then you improve operations, modernize systems, bring in automation, and let the machine keep paying. That is not romance. It is economics. The 12th asset is alternative stores of value gold. Bitcoin, hard assets outside the banking system. I do not think of these as the core engine of wealth. I think of them as insurance against the sins of governments and central banks. Every currency system eventually gets pushed too far. Debt grows, printing grows, savers get diluted. At those moments, people who own at least some assets that cannot be manufactured with a keystroke sleep better than those who are completely loyal to paper promises. Gold has done that job for a very long time. Bitcoin is a newer version of the same instinct, though far more volatile and far less proven across centuries. I would not make this the whole portfolio. That would be foolish. But I would absolutely understand why serious investors want some share of their wealth outside a system built on debt expansion. The 11th asset is farmland and productive land. There is something wonderfully stubborn about good land. They are not making more of it. And when the land is productive, it does more than simply sit there. It can produce food, lease income, appreciation, and a long duration hedge against the inflation of everything built on paper. I have always liked assets with utility land that feeds people is about as useful as it gets. The wealthy understand this better than the public does. That is why productive acreage keeps finding strong hands. It does not need to be dramatic to be powerful. It only needs to keep doing its job while the currency shifts around it. The 10th asset is private equity and angel investing. This is not beginner territory. That is the first thing I would say is the public market is where many of the best early gains have already passed. By the time a company becomes a household name and a public stock, a great deal of the asymmetry is gone. The extraordinary upside often belonged to the earlier capital. That is what private investing offers. Not certainty asymmetry. Most bets fail. A few work well enough to change the math of the whole portfolio, but access, judgment, diversification, and emotional resilience matter here. If someone treats private deals like lottery tickets, they will probably get exactly what gamblers get. If they build real judgment, real deal flow, and patient exposure, this category can become one of the strongest accelerators of wealth on the whole list. The 9th asset is your reputation and network. This is one of the most misunderstood assets in the world because people think networking is social theater. It is not. A true network is trust compounded. It is the quality of people willing to return your call, stake their name beside yours, introduce you into rooms that money cannot open by itself, and think of you when an opportunity appears. That is why reputation matters so much. Every promise kept adds to it. Every promise broken subtracts from it. The people with the best networks often look lucky from the outside. They are not. They spent years becoming credible enough that others were willing to move with them. That is an asset. And if you neglect it, it decays like any other. The 8th asset is attention, digital assets, and audience trust. For most of history, distribution was the bottleneck. Now the bottleneck is trust. A website that attracts the right audience, a YouTube channel with real loyalty, a newsletter people actually open, a software tool people rely on, a community people care about. These are not vanity objects if built properly. They are cash flow systems. They are distribution engines. They let you create once and monetize again and again through attention that keeps arriving. That is an extraordinary form of leverage. Not all attention is valuable, of course. I do not want random eyeballs. I want trust. Trust is what converts a crowd into an asset. The 7th asset is intellectual property. A course, a book, a patent, a framework, a piece of software, a method. Something you create once that can be sold, licensed, or distributed repeatedly without you having to restart from zero every time. That is the magic of intellectual property. The marginal cost of the next sale can be tiny while the value remains high. Ideas are strange in that way. They are fragile while being created and immensely scalable once packaged correctly. Most people sit on knowledge they never package because they do not see it as an asset. That is a mistake. The 6th asset is dividend stocks. I have always liked being paid for ownership, not because dividends are the only thing that matter, but because they impose a kind of honesty on the business. A company that can reliably send cash back to owners usually has a real engine underneath it. Then if you reinvest those dividends, something beautiful begins to happen. The dividend buys more shares. The additional shares generate more dividends. Those dividends buy more shares again. And little by little, the compounding flywheel starts turning. It does not look dramatic at first. Then it becomes noticeable. Then it becomes formidable. That is how quiet wealth is built. The 5th asset is index funds and ETFs. This is the most boring miracle in finance. The evidence has been humiliating for professional money managers for a very long time. Most of them, after fees and over long enough periods, fail to beat a simple, low-cost broad index fund that should tell ordinary people something important. Complexity is not automatically intelligence. Most investors would do better owning the productive engine of the market broadly than trying to outsmart it stock by stock. An index fund is discipline built into structure. It lets you own the system, avoid many unforced errors, and keep compounding while everyone else is reacting emotionally to headlines. It should be in almost every serious portfolio, not because it is exciting, because it works. The 4th asset is income, producing real estate. There is a reason real estate has built so many fortunes. Leverage helps. Tenants help pay down the debt. Inflation often helps rents. The tax code has been unusually kind to property ownership for a long time. And time helps because every payment can build equity while the asset itself may appreciate. That does not mean every property is a good investment. Of course, not bad deals exist everywhere, but one well-chosen rental property can do a great deal of work over 10 years. Then another. Real estate rewards patience, structure, and operational seriousness in a way that still makes a lot of sense to me. The third asset is your own business and your equity in it. This is where the ceiling disappears. When you work for somebody else, your upside is capped by the relationship. When you own the business, your upside changes shape entirely. A good business is not merely a job you created for yourself. It is a machine if built correctly. It can throw off cash flow, increase in sale value, and eventually become something you can sell for a multiple that changes your life. That is why business ownership remains such a powerful wealth builder. No ceiling. That is the phrase that matters. You do not need to build a giant public company. You need to build something profitable, systematized, and durable enough that it becomes an asset rather than a self-imposed prison. The second asset is your health. This is where finance people usually become embarrassed because they do not like admitting that the body may be the highest return investment of all. But it is if you are sharper, stronger, more energetic, and more durable, you make better decisions, work longer if you choose to, avoid catastrophic costs more often, and give every other asset on this list more time to compound. The return is not abstract, it is measurable. A person with poor health is operating with sand in the gears. A person who protects health is extending the runway for every compounding asset they own that matters more than people think. And now we get to the first asset, the one that makes almost every other asset possible. Your high-income skills. Everything else on this list needs capital. Capital begins with income, and the person who can dramatically increase earning power changes the speed of every other wealth. Building process. The investor earning $50,000 a year and saving a little is playing one game. The investor earning $300,000 a year through a skill the market values deeply is playing another game entirely. That difference compounded to millions over time. So I always come back to this: learn something the market pays for, then get so good at it that the ceiling keeps moving higher as your mastery deepens. Sales, software leadership, negotiation, capital allocation, building teams, judgment in complex systems. The exact skill matters less than whether it remains valuable, hard to replace, and amplifiable by technology. That is the seed capital asset. And if you neglect it, the whole structure builds more slowly than it should. So if I step back and look at the whole list, I see something very simple: children and legacy, AI leverage, small business acquisitions, alternative stores of value, farmland, private deals, reputation, digital distribution, intellectual property, dividend stocks, index funds, real estate, business equity, health, and high-income skills. Some of those assets produce cash, some produce leverage, some protect, some accelerate, some outlive you. That is why I like the list. It is not one-dimensional. Now, the real question is not whether you enjoyed hearing it. The real question is whether you will move, because the wealth gap is not really an information gap anymore. Most people can access the information. The real gap is action, the distance between knowing and doing. That is where fortunes get built or missed. So if I were speaking to someone seriously about the next decade, I would not ask which 15 of these they admire. I would ask which 3 they're going to start building in the next 90 days, because that is where the future begins, not in inspiration, in movement. And the people who close that gap between understanding and action are usually the ones who look lucky 10 years later. They were not lucky. They acted while it was still small.